Ashland just secured $500 million in new credit, but the fine print reveals a dangerous game of leverage. Ashland has officially entered into a second amended and restated credit agreement. This move establishes a $500 million unsecured revolving credit facility. On the surface, this is a massive liquidity upgrade for the specialty chemicals leader. By replacing legacy debt, they've created a flexible backstop for strategic operations. The bull case argues this provides a war chest for opportunistic M&A activity. It allows them to acquire competitors without resorting to dilutive equity financing. Furthermore, the pricing structure actually rewards the company for reducing its total leverage. As the balance sheet improves, the interest margins and unused fees decrease. The fact that global banks provide an unsecured commitment is a huge vote of confidence. It suggests that the lenders view Ashland's operational stability as highly robust. However, we must look closer at the filing to find the hidden risks. The facility is technically unsecured, but it involves a complex Swiss borrower guarantee. This introduces potential cross-border legal risks and complicated cash repatriation challenges. Then there is the pricing, which is linked to volatile SOFR and EURIBOR rates. Loans start at SOFR plus 1.375% but can jump quickly. If the consolidated net leverage ratio ticks higher, the cost of capital spikes. This creates a dangerous feedback loop during periods of financial or operational stress. The agreement is also littered with tight maintenance covenants on interest coverage. A single bad quarter could trigger a technical default on the entire facility. In such a scenario, the lenders could demand immediate repayment of $500 million. That would ignite a massive liquidity crunch for the company almost overnight. Critics argue the general corporate purposes clause is just a veil for buybacks. Using debt to fund share repurchases can be risky when rates are volatile. The touted penalty-free prepayment is only useful if they have the cash available. If they are forced to refinance after a covenant breach, the rates will be higher. So we are looking at a high-stakes trade-off between flexibility and fragility. The facility transforms the balance sheet from a defensive posture to an offensive one. But this offensive engine requires a steady hand and consistent earnings growth. If Ashland executes its growth strategy, this credit line is a powerful tool. If they falter, the covenants become a liability that could jeopardize the firm. Ultimately, the market's reaction depends on the company's ability to deleverage. Watch the quarterly reports for any signs of leverage ratio instability. This $500 million move is a bet on Ashland's future operational excellence. Whether it's a bridge to growth or a path to a crunch remains to be seen. Keep an eye on the debt to EBITDA ratios as the next catalyst for the stock. The liquidity is there, but the cost of failure has never been higher. Ashland is now positioned for a major move, provided they maintain their balance.